high income child benefit charge. This came in on the 7th of January. 7th of January. This is a bit of a nightmare for the revenue, amongst other things. The reason is the revenue work on individuals. The high income child benefit charge works on households, and the revenue do not know who lives with who. What happens is that if an individual, i.e. one person, earns more than £50,000 and claims the child benefit charge, then there will be an income tax liability, and that income tax liability will affect those people earning between £50,000 and £60,000. If you earn more than £60,000, there will be no benefit in making a child benefit charge, because they will tax you the amount you claim, so you will not be better off. And the way it works is that if you've got two people in the household earning £49,000, you will not be affected. If you have one person earning over 60 and the other person earning nothing, then basically it's not worth claiming it, because they will be affected quite considerably. So it kicks in on the 7th of January. Interesting thing about that is that means that that has to be declared. If it's you, declared on your tax return for the year ended 5th of April 2013. Some people may not have personal tax returns. You will have an obligation to file a tax return if you have that income. So if your partner or wife is claiming the child benefit and you earn over £50,000, you have an obligation to declare that to the revenue. Fill in a tax return, pay your tax. It's not the end of the world in the year ended 5th of April 2013, because this only kicked in the 7th of January. The interesting point is the full year will be in the year ended 5th of April 2014. 5th of April 2014, you pay your tax on the 31st of January 2015. That's when everyone's going to get their big first tax bill. You then, at the same time, have to make 50% of your tax payment on account for the following year. 3 months after that, this country is going to the polls to elect the next government. So I think there may be some problems somewhere along the line there. The problem the revenue have got is they don't know if Miss Smith lives with Mr. Bloggs. Whether they're married or not, this affects you if you're living with a partner. Let's see what we've got there. This bit is really important, this bottom paragraph. I don't know if you can all see it, but for ladies who husbands or partners earn more than £60,000, you might think, and this is your first child, you might think, well, there's no point in me claiming it because I'm not going to be better off. Please don't take that view. The reason is because if it's your first child, then what happens is you need to claim up national insurance credits for when you retire. And by making a child a claim for this benefit means that you can log a credit until your youngest child is 12 years old. If you don't do that, you won't get that credit for when you retire. So this is relevant for ladies. So if you still say, well, actually it won't be worth it because my husband or partner earns more than £60,000, claim it and then tell them you don't want it. Because once you're on the books, you will get your credit until your youngest child is 12 years old. And that will make a significant difference when you retire. And people don't automatically notice that. So you want to be aware of that. It's one of the vagaries. I don't think it's been publicised enough. What can we do to influence this? Well, say for the sake of argument, if we assume it's a husband, and I'll tell you why we're assuming a husband in a minute, if he's earning £52,000 and if you have income from your HMOs, what you need to do is, what we suggest for our clients is we have a special dividend structure. If you do have dividends, the choice would be, in this scenario, husband earns 52, wife earns £7,500 salary, so the company gets tax relief on it. Wherever possible, use this dividend structure. If your accountant hasn't done it for you, speak to him, such that the wife can have the dividend, not the husband. If you increase his income, you'll lose more of this tax benefit that you'd otherwise get. If you're married, if the husband has dividend income, investment income, he could give that share portfolio to the wife, and she could receive that income to make sure that he's not more disadvantaged, or you're not disadvantaged as the unit. The reason I'm citing husband and wife is there's no capital gains tax on transfer of assets between husband and wife. If you're not married, there is. So it's more relevant. So you might need to consider it more closely if you're not married. But it's still going to be relevant to make sure that, that's what I said at the bottom, it may trigger a tax charge if you're not married. If you are married, the transfer of assets between spouses won't trigger it.